If you're investing in the S&P 500 and all you're doing is buying it every month, you could be leaving thousands of dollars on the table over the long run. Not because you picked the wrong investment, but because you're missing a few simple steps that can make a surprisingly big difference over decades. So in this video, I'll show you 4 simple steps to help you get the most out of your S&P 500 portfolio and give your money a better chance to build long-term wealth. My name is Martin, and I've spent years researching personal finance so you don't have to. So let's start with step 1. Build the right foundation. Most people think investing in the S&P 500 is simple. They open their brokerage app, type S&P 500, click the first fund they see, and assume they're done. That's how the average investor starts. But one small decision early on can quietly reduce how much of your money stays invested and compounds over the decades. If your goal is long-term wealth, don't just buy the S&P 500, buy it the smart way. Instead of choosing the first fund you see, look for a low-cost S&P 500 index fund. Like Vanguard are among the strongest long-term choices, because they track the same S&P 500 while keeping annual fees extremely low. Those fees may look tiny today, but every dollar you don't pay in fees stays invested and keeps compounding year after year. But choosing the right fund is only half the job. The account you invest through can make an even bigger difference over time. Now, let's choose the right account. If your employer offers a 401k with a company match, start there first. That's one of the few opportunities where your investment immediately gets an extra boost. If you don't have access to a workplace retirement plan, a Roth IRA is often the next best option for eligible investors because qualified withdrawals in retirement can be tax-free. If neither option is available, or you've already maximized them, then use a regular taxable brokerage account. The investment can be exactly the same, but the account you choose determines how much of your long-term returns you actually keep. This is the framework I personally follow for long-term investing. Keep more, pay less, compound longer. Every investing decision should pass these 3 filters. Keep more of your money invested by choosing lower-cost funds. Pay less through the right tax-advantaged accounts whenever possible. Then give your investments enough time to compound without interruption. Average investors chase higher returns. Smart investors build a system that helps them keep more of the returns they already earn. Now your foundation is built. But surprisingly, this is where many investors make their biggest mistake. When the market finally gives them their greatest opportunity, they mistake it for their biggest risk. Step 2. Turn market crashes into opportunities. When the S&P 500 drops 10%, 20%, or even more, most investors make the same mistake. They panic, they stop investing, and many even start selling. Smart investors see the same market differently. They see a temporary opportunity to accumulate more ownership, while quality companies are trading at lower prices. If you've already planned for moments like these, a major market decline can be the time to temporarily increase your investment above your normal monthly amount. You don't need to predict the exact bottom. Simply invest a little more while prices are temporarily lower. Then return to your normal monthly investment once the market stabilizes. Even Warren Buffett has long viewed market downturns this way. A market downturn doesn't bother us. It is an opportunity to increase our ownership of great companies with great management at good prices. The same principle applies when your income grows. If you receive a raise, a promotion, or an annual bonus, don't let every extra dollar disappear into lifestyle inflation. Increase your monthly investment by a small amount, and keep part of that extra income ready for future market opportunities instead of spending it all. Finally, make it a habit to increase your investment by at least 1% every year, or more if your finances comfortably allow it. Those small increases may seem insignificant today, but over decades, they can significantly strengthen the power of compounding. One final rule: don't invest more just because the market is falling. First, understand why it's falling. If the long-term fundamentals remain strong, and the decline is driven by temporary fear rather than a permanent change, that's when a market downturn can become an opportunity, not a reason to panic. The market gives opportunities, but only prepared investors are able to use them. Let's fix that next. Step 3. Build a cash buffer before you invest. Imagine you suddenly lose your job, face a major home repair, or receive an unexpected medical bill. Without a cash buffer, your investments can quickly become your emergency fund, and you'll most likely be forced to sell them, not because you want to, but because you have no other choice. Investing is important, But protecting your investments comes first. That's why, before investing seriously, make sure two things are already in place. First, build an emergency fund covering around 3 to 6 months of essential living expenses. Keep it in a high-yield savings account where your money stays liquid while earning around 3 to 4% interest or more, instead of sitting in a traditional savings account, earning almost nothing. Because emergencies don't wait. Having cash set aside means you won't be forced to sell your investments when you need money the most. Second, eliminate high-interest debt. If your credit card is charging 20 to 25% interest, while your investments are expected to earn around 8 to 10% annually over the long term, you're likely losing more in interest than you're making from investing. That's why I follow one simple rule: protect first, invest second, compound forever. Because protecting your investments comes before growing them. Now that your money is protected, let's make sure your investing keeps growing automatically without emotions, even when life gets busy. Step 4. Automate your investing. Set up automatic investing one day after every payday. That way, your investments grow before your lifestyle does. Whether you're investing through a 401k, Roth IRA, or a brokerage account, schedule your contributions to happen automatically. Money should move into your investments before it has a chance to disappear on unnecessary spending. Even a small increase today can create a much bigger difference over time. And whenever you increase your investment amount, update your automatic contribution too, so your investing plan stays consistent, even when life gets busy. Automation removes the two biggest enemies of long-term investing: emotion and inconsistency. You won't have to worry about timing the market, forgetting to invest, or deciding whether today is the right day to buy. Your money keeps working, whether the market is up, down, or moving sideways. That's why I follow this one simple rule: automate first, stay invested, compound always. Building wealth isn't about making one perfect investment. It's about building a system that keeps investing month after month, year after year, without relying on motivation or emotions. The S&P 500 has helped build wealth for millions of long-term investors, but simply buying it won't make you a more successful investor than the average one. The real difference comes from consistently following these 4 simple steps: investing through the right account, taking advantage of market opportunities, protecting your investments with a cash buffer, and automating your investing. Along the way, keep making small increases to your investments as your income grows. That's what gives your money a much better chance to compound over decades than what most investors ever achieve. But remember, these 4 steps only work if you apply them consistently, not just learn them. And if you found this video helpful, make sure to like and subscribe. I'll see you in the next one.